Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Minash. This is the weekend edition where we interview notable people from the world of real estate investing. Today is no exception. We have a great guest all the way from Park City, Utah. Welcome to the show, Nathan Resnick.
Hey, thanks for having me.
Great to have you here. Now, Nathan, you're part of the Cost Segregation Guys team, one of the sponsors of our show, which is awesome. And excited to have this conversation because Cost Seg is one of those things that just unlocks a lot of value in projects, especially with some of the tax changes over the past year. And before we dive into the details, perhaps give a little bit of your backstory and how you got to this point in your journey.
Yeah, totally. I mean, I was a software executive before this at a software company for over 10 years. And as my income grew, I realized depreciation is a fantastic tax strategy. And so started investing in real estate myself over 8 years ago. I now own a few short-term rentals here in Utah. And then I'm an LP in over 100 different funds. So, both syndicators and funds across different real estate assets. And now I'm a partner at Cost Segregation Guys. So I've been at the firm for almost 3 years. We've, I think, become the top cost segregation firm nationwide. And really excited to just be helping people in real estate with bonus depreciation.
Love it. Now, we often, we hear about cost segregation, and it's really first and foremost about accelerating depreciation. Because if you don't do a cost segregation, you're depreciating your asset over, depending on the property, 27 and a half years, 39 years, whatever it might be. Meanwhile, you're out spending the cash on your property and you don't get to deduct it unless you actually take that asset apart into its constituent pieces and say, you know what, my refrigerators don't have a 39-year life. They can be depreciated faster. Most of them will not last that long, especially today. And then many other aspects, carpeting, asphalt, so many different elements to really pick this thing apart. Talk a little bit about the process of cost segregation, how your company comes into play here. Who are some of the different players involved?
Yeah, really good question. I mean, I think when it comes to bonus depreciation, the first thing to understand is really the time value of money, right? It's always better to have a dollar today than in, 27 and a half years or 39 years, right? And so I think that's really kind of the fundamental thesis of cost segregation and bonus depreciation is you're taking those assets or those parts that you're building and accelerating depreciation. And right now with 100% bonus depreciation being back, you can accelerate that to year one, a lot of those, assets within that building to year one. And so you're going to basically improve your cash flow in year one by being able to offset a lot of those taxes that you'd otherwise have due on that income in year one. And so you can offset that across your income. You could offset that as pass through to LPs in a different fund or syndication that you have. And so, I think fundamentally, cost segregation is not just a tax strategy, it's also a cash flow strategy because it's going to improve your cash flow in year one and through the lifetime of that property.
Now, of course, I'm certainly not an accountant. I doubt that you are as well, and our job is not here to provide tax advice, but to really open the possibility. Having said that, not everybody qualifies for bonus depreciation at the same level. Not everyone can use it the same way. Can you break that down a little bit?
Yeah, totally. So with most people in their tax return, there's active income and passive income, right? Active income could be from your W-2 job. Passive income could be from stock trading portfolio. It could be from your real estate, stuff like that. And so bonus depreciation, if you're not filing as what's called REPS, a real estate professional status by the IRS, which means you spend 750 hours a year or 14 hours a week focused on real estate, then bonus depreciation only offsets passive income. Now, I think what a lot of people don't understand and kind of miss when it comes to tax strategy is that if they have a stay-at-home wife or stay-at-home partner that they jointly file with, if your partner can get rep status by looking on Zillow or managing your property or whatever it may be, then jointly filing your bonus depreciation can then also offset all of your income, right? And so I think in general, bonus depreciation is a great strategy if you're filing as reps or not, because even in year one, let's say you have more depreciation than you have to offset your income, you can also roll that forward. So there's a lot of benefit there. A lot of people, I think, misunderstand that in terms of, I don't have enough passive income this year. Well, you can also roll it forward, right? It's not one of those, you're not going to lose it.
So you might get someone who will say, I'm going to go out, I'm going to get my real estate broker's license, and so now I'll qualify as a real estate professional. And that's not necessarily the case, because if they're not putting in that requisite number of hours, the IRS will disqualify it. And conversely, you might say, like you just said, well, I'm a physician. I don't have 750 hours a year to put into being a real estate professional, but a spouse might be able to create that offset. So those could be different elements of the strategy that can allow for the bonus depreciation to offset other classes of income.
Yeah, that's for sure. I mean, we see a lot of, doctors, lawyers, et cetera, that are high income earners and they have stay-at-home wives, and getting their wife to file as a real estate professional by managing their properties or managing their real estate portfolio or looking for new investments that qualifies, and filing jointly. I mean, you imagine, right? Let's say you're a high income earner making $500K a year. Your tax liability every year is in the six figures.
It's enormous.
Yeah, it's enormous. And so just by filing jointly and having that, rep status, you're likely going to be able to offset the majority of that tax bill, which is huge, right? Especially over time. And so what a lot of our clients do is every year they look for new properties to invest in or new funds to invest in. And that's, my strategy as well in terms of continuing to be an investor, both, actively myself buying my own properties, but also as an LP in different funds that, give me exposure to other markets that I'm not as tapped into myself.
And one of the frequent objections that I hear is, okay, I can get this tax deduction, but I'm only going to hold on to the property for 5 years. Now get this bonus depreciation. Instead of paying capital gains tax on the sale, I'm going to end up paying a whole bunch more on the recapture of the new cost basis at an ordinary business income rate, which is, of course, a higher income tax rate. It's a losing proposition. What say you to that objection?
Yeah, it's a really good question, really good point. I mean, I think in general, for most people to get into real estate, most of that money should be kept in real estate and asset class by rolling it forward through a 1031 exchange. And when you 1031 exchange into a new property, you push forward that recapture as well. And so I think in general, my opinion, and this is just my opinion, is that the money that you invest in real estate in general should stay in real estate long term. And if you sell a property, you should pretty much always 1031 into something else, just because, the capital gains that you're going to pay, as you mentioned, on that property and the recapture is going to make it so that the 1031 is going to become even more attractive. And if you think about, long-term wealth building, we're all going to die at some point. And when you die, right, the cost basis goes up to the current value. And so I think that's how you see a lot of real estate investors over decades to build up this vast portfolio tax-free, because they continue to use bonus depreciation and 1031 exchanges to basically build this incredible portfolio over their lifetime.
When I think about taking a property and you're going to segment it into different useful life, some is 5-year property, some is 15-year property, some might be 27 and a half year. Of course, land does not depreciate, so that's the longest depreciation of all. If you're holding the property for 5 years, and let's say you have 5-year property claimed in your cost segregation study, at the end of 5 years, at least on paper, that property is used up. It is fully depreciated. So the recapture value of that 5-year property at that point is zero. Am I understanding that correctly?
Yeah. I mean, you're going about it the right way, right? So our engineers, with every study that we do, we look at assets within a property, whether it be the flooring or ductwork or HVAC or whatever it may be, right? And this is across every property type, right? And I think that's why every property is different. And you should always use an engineer-based study. It's because then you put the assets within a property within that 15-year mark and allocate that accordingly. An engineer is going to know exactly how to allocate that on your cost segregation study, which is, like you said, a depreciation schedule that you'll then have on your study, and then can, report that on your tax returns to have that bonus depreciation.
Many of the investors that I hang out with, if they have a particular year in which they say, oh my gosh, I'm going to have a tax problem this year, which means they made a lot of money, congratulations. often what they will do is they will probably in the fourth quarter start to think about, well, I better go buy an asset in the fourth quarter so that I can then claim bonus depreciation on that asset in order to take a bite out of that tax bill, because now I'm making a capital expenditure and instead getting an actual business write-off for that capital expenditure. So you're doing a balance sheet transaction but getting an income statement benefit from it. Do you see a lot of folks that work with you employing that strategy?
Yeah, we do. We've done over 10,000 studies across the country. And I would say in general, a lot of our clients say, hey, I know I have $1 million in tax liability this year. I need to go find real estate that can offset that tax liability. Now, what I always say as a real estate investor myself is that, look, the fundamentals of the deal still have to be strong. I think when you get in a tricky situation as an investor is when you go out chasing depreciation. And if you even look across different asset types that we handle cost segregation studies for, some of the highest depreciation schedules are in car washes and laundromats. But the fact of the matter is car washes are trading at like a 5 cap or sometimes below a 5 cap, right? And so if you look at it that way, you can get a better return in other asset types. But maybe in a car wash, you're going to get for every dollar you put in $1.10 or $1.30 in depreciation, depending on the actual car wash and the equipment within it. But that equipment in a car wash or laundromat has a very strong depreciation schedule that gives that strong benefit. But then your kind of actual investment analysis and thesis of that property at a 5 cap maybe isn't as attractive as a multifamily development or, industrial, whatever it may be. And so I think at the end of the day, what I always tell our clients and what I talk about is, look, deal fundamentals have to be there, and depreciation should be kind of that cherry on top and that added benefit of the deal, right? I think when you go out and chase depreciation is where sometimes get a little lenient on your deal fundamentals.
Well, to quote Tom Wheelwright, the accountant, never let the tax tail wag the investment dog.
Yep, exactly. Yeah. And I think, look, we're all caught in that situation many times, right? But I can tell you as an investor myself, there's been times where I've been trying to be aggressive on my end from a tax strategy standpoint and chase that depreciation. And a lot of those deals that I went into with that mindset of, oh, this is a great property for appreciation, the actual kind of cash on cash return has not been as strong compared to when I actually focus on the deal fundamentals and get the cherry on top of depreciation.
Love it. Well, Nathan, if folks want to connect, if they want to learn more, what's the best way?
Yeah, they can just go on our website, costsegregationguys.com, or my personal email is just at costsegregationguys.com. So just the letter N at costsegregationguys.com. And, I'm an active investor myself, so always looking for new deal flow, and I really appreciate you having me on.
Awesome. Well, Nathan, great to catch up. And for the listeners at home, definitely want to connect with Nathan at the Cost Segregation Guys. The links will be in the show notes. And in the meantime, have an awesome rest of your weekend. Go make some great things happen. And we'll talk to you again tomorrow.